Welcome back. A very important question you should ask before you start investing is how much money should you invest in the stock market? In this video, I'm going to share my thoughts on this topic. The first point you should remember is that each individual's personal and financial situation is different. So it is imprudent for anyone to give a specific number or percentage income or assets that might work for everyone. In fact, I will go one step further and urge you to not pay attention to some common formulae for asset allocation that are touted in media. For example, one common suggested formula is 100 minus your age is the percentage allocation you should have to equities. This kind of a formula is flawed not only because it fails to consider the specific situation for every individual, but also because it does not take into account the possibility of wild fluctuation in investment value, which may lead to liquidity issues for the investor. Consider this example. A recent graduate from college may have limited savings even after working for 2 to 3 years. He may also be servicing an education loan. In such a scenario, if he decides to invest close to 70 to 75% of his savings in equities, he runs the risk of getting into liquidity issues very early in his life. What if the stock market crashes and his portfolio goes down by over 30%? Will he be comfortable exiting at such a loss? What if the market-wide crash is so severe that he ends up losing his job? He will immediately run into trouble, not just for his living expenses, but also on his education loan. Ideally, you should only invest some portion of your investment portfolio into the stock market. I will explain what I mean by investment portfolio, but before that, let's define some terminologies first. Savings in a given month is given by savings equals income minus expenses. Income may be income from salary or business or profession or even multiple sources. Expenses should include both essential expenses and discretionary expenses. Essential expenses include living expenses, rent, loan repayments, health and life insurance premiums. Discretionary expenses include expenses on travel, luxury, leisure, and other non-essentials. Accumulated savings is essentially the sum of your savings over your lifetime. Emergency fund is a fund that one should always hold, and it should include at least 6 months of essential expenses. If your accumulated savings is less than your required emergency fund, then your first priority should be to build up your emergency fund. Hence, most of your monthly savings should go to your emergency fund first. Needless to say, no part of your emergency fund should be invested in equities. In case your accumulated savings is greater than emergency fund, then the excess of accumulated savings over your emergency fund value is your investable surplus. Before you decide on the percentage of investable surplus that can be invested in equities, you need to figure out your foreseeable fund requirements over next 2 to 3 years. For example, if you know that you would require a sum of money in the next 1 to 2 years, say for meeting some obligations, then this amount should also not be invested in equities as equity returns are volatile. This fund requirement must be invested in products which provide fixed returns. After you deduct all your fund requirements over next 2 to 3 years from your investable surplus, you arrive at the sum that is available to you that can be allocated to equities, and we will call this the investment portfolio. While your entire investment portfolio can be allocated to equity, it is not advisable to do so for everyone. For example, if you have just started working, it is possible that this investment portfolio is only 20 to 30% of your entire savings. In such a case, it may be possible to allocate this entire capital to equities, On the other hand, if you are in your early 50s, it is possible that your investment portfolio is more than 60 to 70% of your entire savings. Since you are only few years away from your retirement, it won't be advisable for you to allocate your entire investment portfolio to equities. For example, if you have created a corpus for your retirement, you would not want most of it to be allocated to equities. Instead, most of your portfolio should be allocated to instruments which offer fixed returns, and only some portion, say 20% of your corpus, should go into equities. When investing in equities, one should try to diversify into multiple mutual funds and individual stocks in order to protect yourself from losing too much money in one equity investment. Doing so also has the benefit that some securities may provide positive returns, which may offset negative returns from some other securities. For investors who are risk averse, this reduces the overall volatility in returns from your equity investments and helps you stay invested for longer periods during times of volatility. Now that you have some idea as to how much money you should invest in the stock market, in the next video we are going to look at how much money you should invest in an individual stock. So see you in the next video.